cyber attacks on financial institutions, nothing new. The concern about exposure to that could be widespread if this becomes to be a full-scale invasion. To read on all of that with the CEO of Bank of America, Brian Moynihan, who joins us right now. Mr. Moynihan, very good to have you.
It's good to be here and good to hear you back, Neil.
Thank you very much, Brian. Let me first get your take on the worry about cyber attacks. You've dealt with this, and of course, been leading a charge to respond to these type of developments. This seems localized for the time being to Ukraine. What do you make of them and the possibility of them growing as things get more heated?
Well, the issue of cyber attacks obviously gets elevated during a time of strife and geopolitical activities, because that's one of the ways that the war is waged. But on the other hand, if you think back more broadly, and you referred to this, Neil, at our company we invest $1 billion plus a year in cyber defense. We have thousands of people working on it. All our teammates have to work on it to be good, and so we do a lot to protect our flank. And then with the industry and with the administrations going back for the last 2 or 3 administrations, we've worked closely with them on informing, and they're giving good access and good information to our industry and other key industries to make sure we're informed of what's going on. And frankly, they have been having meetings leading up to what's going on to keep us informed and make sure we understand what's going on, and that goes on every day.
Yesterday there was some concern about exposure, financial institutions' exposure to what's going on in Russia and some of the, or Ukraine and some of the players, including those with ample exposure to Russia. And in Austria, and Italy, and France, not surprisingly, they have a number of big players that do have a great deal of exposure. The Dutch lender ING, Austria's RBI, I could go on. HSBC, the European the bank, had worried about the potential of a contagion. Are you worried about that?
Well, we're always worried about contagions from anything, and obviously geopolitical events is one of those things. Our exposure in Russia is very limited. We have a business there that operates in the capital markets and investment banking and corporate banking, but it's a very small exposure to us. But you do worry about other people have bigger exposures you have exposure to. But frankly, through all the work we do on counterparty management in our company and across our industry, frankly, since the financial crisis, the understanding of where the positions are, the exchange-traded positions versus bilateral positions not known, all that works to make sure the regulators and ourselves know where the exposure is, and we all work to mitigate it in times of stress, and this is one of those times.
It's been a volatile time for the market, for virtually all sectors. This coming, when interest rates rise, the feeling was that banks would benefit in an environment like this, yours included, and now you have this cloud with the Ukraine. How do you see this all factoring out?
Well, it's hard to predict something that's completely, not within the control of the banking system. But if you think about it, more backing up more, Neil, to your point, just to be clear about it, we saw 6% growth, round numbers, in the United States last year. The expectation is 3.5% to 4% this year, and next year, meaning 23, it would come more in line with trend growth at 2.5%. And that's because the economy got overheated with the fiscal work that was done by the administration, the Trump administration, the Biden administration, and helping put lots of money in the economy to offset the impact of the pandemic, and then obviously the monetary accommodation, and that's not needed anymore. And so the Fed is going to move rates up, and that will bring the economy more along trend growth lines and hopefully deal with inflation and deal with it well. When you have something like these geopolitical events come in, that creates in a supply chain events, that those are creating additional uncertainty around the outcomes. But the reality is we feel good about the U.S. economy, what we see on our consumer base and spending, what we see in our corporate customers and borrowing, and credit availability. Everything is very strong. The capitalization of banks, the liquidity of banks. But the reality is things will ebb and flow. But if you look at it, the sector's in great shape to support the real economy, and you're going to see that economy grow, and it's going well. Unemployment's low, and wages are growing. Things like that are good. It's just we got to get inflation under control at the same time.
And maybe the Federal Reserve addresses just that next month. It's expected to raise interest rates at least 1/4 point. Others are saying it's going to be 1/4 point each Fed meeting every 6 weeks, and maybe additional 1/4 point hikes, maybe a 1/2 point hike thrown in there. Where are you on this?
Well, our team at Bank of America Research, which is the best research team in the business. Michael Hartnett made some news about a month ago when he said they were going to do 7 times this year, and at the time market was 3. Right. The market's moved up into 5, 6, 7. So I think you're going to see them try to normalize it more quickly than before, absent some other extraneous outside their control events. Because the fact of the matter is, the economy is as big as it was in 19, round numbers. The unemployment rate is full employment plus. The inflation is in there, and so they've got to move faster to normalize, because the rate of recovery was much faster due to the strong fiscal stimulus and monetary stimulus. So the idea that the Fed would move faster than people thought doesn't surprise me at all, and I think they know they need to. Now the question is, the pandemic path is always unpredictable, and we all know that, and geopolitical events can be unpredictable, but inflation isn't temporary. No one, that's last fall's debate. It has to be dealt with, and I think moving rates up will deal with it, and you'll see them move relatively quickly. 7 times this year would be probably on the outside. 5 times 6 times the market. That's a 1.5%. It was 2% back in 19 when the economy was this big and predicted to grow at half the rate it's growing now.
All right, so you're talking about the Fed funds overnight bank lending rate that had been at 0. All of a sudden now it gets up potentially in the 1.5 to 2% neighborhood. But do you think the Fed is taking its sweet time on this, Brian? I mention it because New Zealand today hiked rates for the 3rd time. We've seen a host of other countries from the UK, South Korea, Mexico, Pakistan, Brazil, I could go on, who have started raising rates. And here we sit. What do you make of that?
Well, I think they've been clear that they're moving, and then the market gets ahead of them. So you've seen the 10-year Treasury rates move up by 30, 50 basis points. You've seen the 2-year Treasury rate move up. So the market always discounts the future and moves up, and so they're frankly the benefits of a higher rate structure are already coming through the market even before they actually take action. So they know what they need to do. They have the tools to fight inflation. They have to apply them. They have to be careful not to over-apply them, because that causes a recession on the other side. And we're going to live through a period of turbulence as we kind of sort through this. But the reality is, if you look at the underlying activity by our consumers, in the month of February, in the first couple of weeks, they're spending 12% more than they did last February in the first couple of weeks. Year to date, it's 15%. The numbers of transactions are up 11, 12%. So it's not just the dollar volume, which you could say inflation, but the numbers of transactions. The consumers have multiples of the money in their account than they did before the pandemic, and even last year, when this is the end of stimulus, kind of came off this quarter. Since then, their account balances are up 40, 50% than they were last year. So they have money to spend. They're spending. They're employed. Wages are growing. We got to pull more workers in off the sidelines for the good of America, so we can get even more productivity out of this great nation's economy. The supply chains are getting a little bit better. There's still work to do, and all that should bode well. So the Fed has to move to normalize, and the pace that they'll have a lot of models and debates, but the market's already ahead of them pushing it forward.
You're right about all the consumer spending and other numbers, and and the asset and how their balance sheets look for Americans a lot better than they were. And I'm just wondering, though, with some of these consumer sentiment surveys that show they're getting a little concerned, they're not quite as robustly optimistic. Do you see them retrenching a little bit? Do you see them maybe less inclined to take out a loan in this environment? What do you think?
Well, I think, so if you think about in terms of their spending is as strong in February as it was in January. It was really strong in the fourth quarter, but that was sort of coming, especially in the early part of the fourth quarter. You forget that was when the world pretty much opened up fully before the Omicron variant hit. So so that's kind of all behind us. You're seeing basically all states reduce any restrictions. Outside venues are open. We're seeing travel spending up 80% in the first part of the year here. That isn't people traveling necessarily in January, February. It's booking the summer travel, because frankly you can't get it if you don't book it. So you're seeing the economy move ahead, so they feel good about it. Where they can get worried about is, frankly, inflation. And that's why the Fed has to bring inflation under control, because it always feels good when your house price is going up. But if it's going up that much, that means to buy a house, if you sell your house, you're going to pay a lot more. And as rates move up in mortgages, that'll slow the housing market down. But being up 18% year over year is probably not a sustainable way for the American, because population growth is relatively low. Why would housing be up that much? So it's recovery recovered, it's moving forward, and now we got to bring things back under control. That'll create a little bit of, not as fulsome, all trees grow the sky mood on the consumers. But if you look at their day-to-day activity, they're voting with their feet, they're out doing stuff, spending money on restaurants and travel and things like that, which is good for the U.S. economy.
Well, my wife can't do it all by herself, Brian. I keep telling her that, but she's doing her darndest. Very good seeing you. Thank you very much for joining us.
Hopefully she's a client of ours and using our credit cards. Thank you. Thank you, Neil. Good to see you back in action.
I'll check her. Brian Moynihan, CEO of Bank of America.